Hi guys, welcome back to our YouTube channel. I will explain in just 10 minutes why the recession is happening in 2023. Hitting the like and the bell buttons means a lot to us. So, let's get into it. In the year 2023, the global economy may be on the verge of entering a recession, followed by a string of financial crises in emerging markets and developing economies that would cause long-term damage to these economies. This year, central banks worldwide have been raising interest rates with a degree of synchrony not seen in the preceding 5 decades. According to the analysis, this trend will likely continue well into next year and may even accelerate in the year's second half. However, the currently anticipated path of interest rate rises and other policy interventions might need to be revised to bring global inflation back to levels seen before the pandemic. Investors anticipate that global central banks will boost monetary policy rates to over 4% through 2023, which would increase by more than 2 percentage points over their average rate in 2022. What is recession? A significant drop in economic activity that is widespread and continues for an extended period is known as a recession. From the previous expansion's peak to the bottom of the current downturn, economists estimate the length of a recession. Even though a recession can only last a few months, the economy might not return to its previous activity level for years. The last 10 recessions have been accurately predicted by an inverted yield curve, although some of the forecast recessions have yet to pass. Because unemployment rates sometimes remain high well into the later phases of an economic recovery, the first stages of a comeback can feel to many people like a continuation of the crisis. Nations implement fiscal and monetary measures to reduce the likelihood of their economies entering a downturn. What are the root reasons for a recession? A recession is brought about when a series of events, similar to a line of dominoes, begins to gain speed and does not stop until the economy begins to contract. Each occurrence is linked to something that took place in the past and will take place in the future. If the cost of a hamburger continues to rise, you could stop purchasing them. A restaurant would be impacted as a result of this, and a server would also be impacted. This is only one of many interwoven chains that may be found across the economy. Inflation got worse throughout 2021 and 2022. The prices of almost everything went up. The cost of car parts went up. Then the price of cars went up. Many products were affected in the same way. High inflation worried the White House and the Federal Reserve, but their efforts to bring it down didn't do much. They knew that inflation would set off a chain of events that could hurt the economy, but they were still surprised when prices kept rising. Controlling inflation is the job of the Federal Reserve. So in March, they raised interest rates for the first time since the pandemic started. By raising interest rates, people will have to pay more to borrow money, which is supposed to make them stop spending so much. At first, it appeared that they had done well. A lot of people thought inflation would slow, but then Russia's long invasion of Ukraine caused many economic problems. The rate of inflation sped up. Then more dominoes started to fall. One chain of events split into 2 chains of events that moved quickly. First, there was a significant drop in the stock market. This took away a lot of money at once. That can cause an economic downturn. And second, both businesses and people started to worry about the future. People who worry about the economy might keep their money and stop spending. Taking these kinds of steps can help bring inflation down. This time, though, that didn't happen. Russia's invasion of Ukraine drove up the price of gas, which in turn drove up the price of many other things. The chance of a recession also went up. As people worried more about the future, it became clear that a recession would happen. Some businesses started getting ready to stop hiring. This usually happens before a lot of people lose their jobs. The Fed had to raise rates even more because prices kept going up. This means a recession could be coming soon. We seem to be on the edge of a cliff. Recession 2023. If supply disruptions and labor market pressures do not ease, the global core inflation rate, excluding energy, could reach approximately 5% in 2023 due to interest rate increases. This would be nearly double the 5-year average that existed before the pandemic. The model presented in the paper suggests that to reduce global inflation to a rate compatible with central banks' aims, national central banks may need to increase interest rates by an extra 2 percentage points. If this were coupled with volatility in financial markets, global GDP growth would decelerate to 0.5% in 2023, a per capita drop of 0.4%, which would meet the criteria for a global recession. Growth on a global scale is decelerating noticeably, and additional deceleration is predicted as more nations enter a recession. David Malpass, the president of the World Bank, "My great concern is that these trends will continue, with long-lasting effects that are catastrophic for people living in emerging market and developing economies. To attain low inflation rates, stable currency, and faster growth, authorities could shift their attention from cutting consumption to increasing production. This would allow them to fulfill all of the goals mentioned above. Policies should work toward increasing total investment, improving productivity, and allocating capital, all of which are essential for economic expansion and alleviating poverty." The research sheds insight into the unusually precarious conditions under which central banks are waging war against inflation in the modern era. Multiple past indications of global recessions have already begun to sound alarms. Since the 1970s, the global economy is currently experiencing the most severe slowdown that has followed a post-recession recovery. Consumers' confidence worldwide has already experienced a significantly more severe decrease than what was seen in the run-up to prior global recessions. The United States of America, China, and the Euro area are the 3 largest economies in the world, and all 3 of them have seen a significant slowdown recently. Under these conditions, even a moderate blow to the world's economy over the following year could be enough to push it into recession. The study uses lessons from prior global recessions to assess present economic activity and predict 2022 to 2024 results. A slowdown like the current one generally requires countercyclical measures to boost activity. Despite this, many nations are cutting economic support even if the global economy is declining rapidly. In the 1970s, the policy responses to the worldwide recession in 1975, stagflation, and the subsequent global recession in 1982 highlighted the risk of permitting inflation to remain high when growth is poor. The 1982 global economic collapse coincided with the second slowest growth rate in developing economies during the past 50 years, behind only 2020. It caused over 40 debt crises and a decade of negative growth in several emerging countries. The recent tightening of monetary and fiscal policy may help reduce inflation. However, because they are synchronized across countries, they may be mutually compounding by tightening financial conditions and increasing global GDP. Policymakers in developing countries and emerging markets must be prepared to control policy spillovers. Central banks should maintain fighting inflation because they can do so without causing a global recession. To attain this goal, many policymakers must coordinate. Central banks must maintain their autonomy while communicating policy choices. This may underpin inflation expectations and limit tightening needs. Central banks in mature economies should examine cross-border spillover effects while tightening monetary policy. Growing economies and emerging countries must strengthen macroprudential laws and build foreign exchange reserves. Why it is so important. Economic forecasting serves no use but to give the appearance that astrology is valid. It is commonly believed that J.K. Galbraith, a professor at Harvard, uttered these remarks. However, this is not the case. Regardless of who said it, the idea that trying to foresee the future is an exercise in futility is still accurate. Take the year 2022 as an example. Nobody could have predicted Russia's invasion of Ukraine, Putin's prolonged struggle that is still going on almost a year later, or the economic havoc that would be wreaked on the rest of the world due to these events, nor the significant increases in interest rates implemented by the Federal Reserve have brought the United States economy dangerously close to entering a recession. As 2023 is here, Compiling all of the forecasts published by Bloomberg News in recent weeks is key. We will know how accurate or helpful they are at approximately the same time the following year. So that's all for today's video. If you like this video and want to support us in doing this, click the like and the bell buttons. We'll have another video for you soon. Take care until then.